All right, welcome Justin, welcome Shania. All right, so today we're looking at capital budgeting techniques, right? This is continuing along in that same module 3 that we were looking at, or continuing from last time where we did we looked at so far budgets and standard costs and variance analysis, right? So this is another topic under the same module, capital budgeting techniques. And to lead off with, we need to know, well, what is capital budgeting? You know, if you're going to learn about different capital budgeting techniques, we need to understand what capital budgeting really involves. And what it is really is this process most firms would undertake when they have to make a decision pertaining to major projects or investments, right? It could be whether or not they should be purchasing on new machinery, or maybe looking at the different options available for some sort of new machinery. Take for example, let's say a company like KISS, and they have a broiler room, and they need to invest in a new broiler, right? And they have options from different companies that are willing to supply them. How will they know which one to invest in, right? That's an example of a major project. A major investment might be another firm, let's say like Home Construction Limited, and let's say Long Circular Mall is up for sale, and they're considering whether or not they should purchase that mall, right? Capital budgeting really involves where we are evaluating these types of projects and investments, and there are different techniques that are available that each have their own advantages and disadvantages that a manager could use to make a decision. Right now, why is it important though, right? And on what it involves. Basically, when you are analyzing these different projects and investments, what the firm is more interested in, or what they look at, would be the cash inflows that will be coming in from that particular project if they were to pursue it, as well as any cash outflows, right? And that sometimes is compared against a particular benchmark or a particular target that the firm is looking at. And they would have that target available, or they would set that particular target to use basically as a benchmark when they're analyzing different types of projects. Now, it's very important in the whole capital budgeting process, right? As I mentioned before, it will help to determine whether or not a project should be accepted, right? It also could be used to determine the amount of capital expenditure the firm would be undertaking, and that as well too would influence, how they're going to finance this project. Is it going to be through debt financing? Are they going to be taking it from reserves, from their retained earnings? Are they going to issue more shares in order to pursue it, right? And they would have to wait in terms of the cost and benefit. They do a cost and benefit analysis about it. From the managerial side of things, it's important for managers to engage in capital budgeting techniques when making decisions, because you are always trying to find that balance between risk and profitability. You see, every time the firm invests, there's some degree or certain level of risk that comes together with the investment or together with the project. And the more risky a project is, or more risky investment is, the firm itself is exposing itself. It is taking a chance in taking on the project or taking up on the investment, that the investment or the project may be unsuccessful, right? Also, taking on too many risky projects is going to affect the firm's ability to survive in the future. It could affect long-term earning. I can give you an example. I remember where I work at SPCS, they wanted the owner, he was looking at diversifying the type of programs that he offers, right? And this was in response to the removal of gate for non-governmental organizations, non-governmental institutions. So currently, you can only receive gate if you attend a government institution with a locally accredited program, right? So you find that all these private institutions that was offering these transnational programs, they were a bit disadvantaged in the sense that they will no longer have that wave of people coming in, because they were getting government funding or was getting support to do. So around that time, he was looking at running a program in auto mechanics, right? And they took on a project to develop a fully equipped automotive lab. So they didn't in fact build an automotive lab, right? And the lab was supposed to be used to run a program or a diploma, an advanced diploma from a UK body called Pearson's, right? And then possibly move on to like a degree if you wanted to in auto mechanics. The lab costs a lot of money, right? Probably in excess of 1.2 million. Is equipped with lifts, hydraulic lifts, everything that you see in a typical garage, like in a car dealership. What happened is the program that they wanted to run, the body that they wanted to run the program with, stopped offering that program probably like a month or 2 months after they were finished building the lab. So the lab was done, and then I mean, you could design your own program to run inside of it, but it would be a lot less credible, and chances are, you know, people would be a little less interested in it. And that was the level of risk that they went with. So, you know, they invested a lot of money, and then things changed, right? The environment changed, and that impacted the firm because by the time that happened, we were already out of gate, right? There was a huge drop in the amount of people registering for the programs offered, because without gate, those programs are relatively expensive because you have to pick up local fees as well as foreign UK fees that are paid in pounds. So there are a lot less people subscribing to those programs. So what that meant was that for the business itself, they had a decline in the revenue that they will usually make because there are less people subscribing to programs. And then you just invested close to 1.2 million in designing a lab that you would not get use out or wouldn't get the anticipated use out of because the program that you were intending to run was no longer available, and you no longer had that cushion of, you know, your programs being gate funded, government funded, right? What that resulted in was decreased cash flows because you had less revenue coming in from students registering for programs. And then you had this cost that you just spent 1.2 million building this facility. And now, you know, you have to figure out how you're going to use this facility and what you're going to do now to recoup that cost, right? They eventually did started offering, they sent some local lecturers to go some courses in the States, and they did you know, hybrid repairs and things like that. And they started offering hybrid courses, which was subscribed. And they even decided to start servicing vehicles as well during the course of the day. So they had to kind of evolve, but that wasn't the original plan. And if you look at our capital budgeting techniques as we go through, it means now that it's going to take a longer period of time for them to recoup the costs. Now, as you're talking about capital budgeting, and we have a real life example, you know, sometimes, you know, decisions are made, and when they don't use capital budgeting type techniques in order to influence decisions, you could run into that problem. Now, although they were looking to run that particular program, you know, we cannot say for certain if, you know, they looked at, you know, what could have been the anticipated cash flows, right? If they did design that that lab, and how long it will take them to recoup that cost, right? Because apart from running the program and recouping costs, remember, these are things that are going to be used on a daily basis, and they're going to require some level of maintenance and repairs. So there's an ongoing cost associated with that. And sometimes when analyzing these projects and these investments, if you do not use the correct techniques and you do not analyze it in any kind of form or fashion, you run that risk of the firm taking a hit or a serious loss from pursuing that particular project or that particular investment. All right, so that's an example where, you know, the firm invested in a particular project and they took on a certain level of risk, and then it hampered their ability to survive. I mean, they had to do a lot of different things. They reduced staff, they adjust salaries, again, because of constant changes in the external environment. You see, a firm is not going to know what the future is going to hold for them, especially in the external environment. And for that reason, you know, firms sometimes set these benchmarks in terms of, let's just say, for example, you know, if they invest in a particular project, a firm might have a policy that they're not investing in any project that is not going to pay off, right, for the cost of the investment within the first 2 years of it running, right? That might be a benchmark that a firm set, and for right reasons, as I just mentioned, right? You do not know what 5 years down the road is going to hold, so you do not want to be at risk for too long. So a firm is going to look to recoup the funds that they put out on the investment as early as possible to minimize risk, right? And improve their ability to survive in the future, because you do not know what the business external environment could hold for that particular business. So that's just a bit in terms of capital budgeting techniques and why it is important for firms. Now we're going to look at more of the accounting aspect, right? Because we're not doing our business class. The first thing we need to look at when we're doing capital budgeting techniques is the initial investment and learning how to calculate the initial investment. Now that might sound a bit weird, because you'd say, wouldn't the initial investment be how much ever money that you're putting out? But no, it could be a bit more than that, right? There's the price of the asset. So for example, with that same thing I gave you with the lab that they built for auto mechanics, right? They may have done a pricing for all of the tools and machinery that they may need, but then there are additional costs like installation costs. I don't believe there was anybody on site or on campus that had the know-how to set up or install a hydraulic lift. So that meant that apart from purchasing a lift, you would have an additional installation cost associated with it, right? Let's just say the area that they were using probably had stock from before. So you may have assets from before. You may sell out some of these assets, right? What is the proceeds from the sale of these assets, right? Sometimes there's changes in working capital, right? Liabilities or current assets. So all of these things are different things you have to take into consideration when we are trying to come up with the true cost of the initial investment, right? So we always start with the cost price of the asset, right? To that, we will add the installation cost. We will take away any proceeds from the sale of all assets, because let's just say we had some assets before, but they weren't fit for purpose or they were outdated. So we sold those and we purchased a new asset. So we have to take away the proceeds that we get from the sale of the old assets. Also, if there were any changes in working capital, we would add that as well. And that gives us our initial investment. This will be better understood with an example. So here's an example. Let's say an asset costs $100,000 with a depreciated value of $40,000, right? Let's say the tax rate is 20%. And let's assume that the asset had a selling price of $70,000. This is the asset that you would have probably gotten rid of. Now, once a gain is made, we have to pay taxes on the gain, right? When we dispose of some of these assets. So the cost price of the asset is $100,000, right? The depreciation is $40,000. So the net book value of the asset is $60,000. Now to calculate the gain, we would always look at the selling price of the asset, right? And the net book value. So the selling price of the asset was $70,000. We disposed of an asset, the selling price was $70,000. The net book value of the asset was $60,000, right? So we had a gain of $10,000. So you have to pay taxes on the gain, right? So the tax on the gain is going to be 20% of $10,000, which is $2,000. And our after-tax proceeds, right? We said that we are selling it for $70,000 and we would have paid tax of $2,000. So after-tax proceeds would have been $68,000. All right, everybody with me so far? Yes?
Yes, sir.
All right. Now let's look at it if a loss was made. Now, if a loss is made, what we get is a tax rebate or a tax refund. The opposite happens. So the same asset, right? The net book value will be the same $60,000. But let's just say the selling price in this instance was $50,000. So we made a loss of $10,000, right? 20% of $10,000, right? That's the tax rate. is $2,000. Instead of subtracting that $2,000 from our proceeds, we will add that, right? Anytime a loss is made, we always do a tax refund or tax rebate, right? And this is what is going to be our after-tax proceeds, right? So that's just a bit on calculating initial investments, right? Now, there are 4 investment appraisal techniques that we have to look at according to the CAPE syllabus. And these investment appraisal techniques could be broken up into what we call non-discounted cash flow techniques and discounted cash flow techniques. The difference between the names of the different types of techniques really lies with the fact that the non-discounted cash flow technique, it does not take into account the value of money, right? Or rather the time value of money into consideration, whereas the discounted flow technique does. Now, what does that mean? Well, a dollar today is not going to be worth the same in the future, right? And this is something when you're doing investment appraisals and budgeting techniques, you have to understand the meaning of the time value of money. And it really refers to the purchasing power of the dollar, right? A sum of money now wouldn't be worth the same sum of money in the future. Like I was having a conversation with my sister recently. I know we was talking about the price of food, groceries, right? So she was saying, remember when we was kids and we used to ride out the road sometimes on a morning to buy bread, right? If there wasn't bread at home. We lived in this residential area and there was this homeless lady that she didn't really have a shop because you couldn't have like a storefront in the residential area, but she used to sell things at her home. You could go there and ring the bell and they had stuff and things for sale there. And I remember purchasing a loaf of bread for like $4.50, $5.50, right? This is while I was going to school. It sounds impossible, right? And now I pay $14 plus for a loaf of sliced bread, like, you know, Kiss Bread, Vital Loaf, that kind of thing. So, I mean, that's a huge, that's more than 100% increase from when I was a teenager in school, secondary school to now. And this is what I mean by time value of money. So even like allowance going to school and secondary school, probably Form 1 to at least Form 3, I used to get dropped to school and pick up. So my dad just used to give me like $10 for the day, right? I mean, this year my son would be going to secondary school, and even if I'm dropping him and picking him up, $10 a day could barely get you more than a juice and probably one snack, right? Whereas when I was in school, you know, a beef pie might have been $2, right? Chubby and what was the other one that they had, boy? They had Chubby, they had another soft drink called Little Boy, right? And that was like $1.50, right? A Coke was $3, a large, the big Coke, right? So clearly you could see that as time goes by, the purchasing power of the dollar sort of decreases, it changes. So when we are doing investment appraisal techniques, right, it's important for the business to take that into consideration. And that's why they may choose to use a different technique over another, especially if the project is going to be generating cash flows over a 3-4 year period, because $1,000 now might not be or worth the same, right, 5 years down the road. Follow us in. So time value of money basically says that the purchasing power of a dollar now is not going to be the same as it would be in the future, nor would it be the same as it was in the past, right? And it's particularly important, and it's the main basis of the discounted cash flow techniques, right? The non-discounted cash flow techniques does not take the time value of money into consideration, whereas the discounted cash flow techniques, which are mainly a net present value and the internal rate of return, they tend to take the time value of money into consideration, and we would see how in a bit, right? So the first one we're going to look at is the simplest technique, which is called the payback period. And this is a non-discounted cash flow technique, right? Here, you're not taking the time value of money into consideration. As the name suggests, basically, you are looking at the time or the period it's going to take the business to recover their investment. How long it's going to take them to recoup the money that they invested in a particular project. Obviously, the shorter the payback period, It's going to reduce the risk of the company, and it's going to improve the company's ability to respond to unforeseen changes. Remember, we were talking about that when I was giving you the example of SBCS. Now, payback period calculations, although, ignores depreciation, right? So basically, it just gives you the amount of time that the investment is going to generate cash flow to pay back for the initial investment, right? Now, we can calculate payback period with both even flows, even cash flows, or uneven cash flows. When I say, or I use the term even cash flows or equal cash flows, I am referring to cash flows where the amount is going to be same or equal each period. So if I have an investment and I am supposed to receive $5,000 monthly, right? That's an example of a even cash flow, right? If I'm receiving unequal amounts, that's an uneven cash flow, right? So the cash flows are not the same in a year. Usually period is a year, right? That's uneven cash flows, right? Now, the rule of thumb when we are using the payback period is you always choose a project with the shortest payback period, because again, you are trying to mitigate risk. You are trying to recoup the money and the investment in the shortest time frame possible. Yes?
Yes, sir.
All right. So let's look at an example with even cash flows. So the payback period, the answer you will get for the payback period is always expressed in years. And it looks at the net cash inflow, right, per year. And that should be the same every year if we're talking about even cash flow. The formula takes the cost of the investment and it divides it by the annual net cash flow. Sounds simple enough. And that's one of the advantages of this method of capital budgeting. It is very easy to calculate. So here's the scenario. Frank intends to invest in a project and it's going to have a 7-year life and it's going to require a $2 million investment in equipment. The project net cash flow from the year is $600,000. And Frank intends to invest only if the project recovery, meaning that the time in which it is he would recoup his investment, is less than 4 years. Remember, I was telling you guys about benchmarks, businesses setting benchmarks for these type of capital budgeting or these type of investments. So his payback period can be calculated by looking at the cost of the investment, which simply in this example was $2 million, and the annual net cash flow was $600,000. So his payback period is roughly 3.3 years, right? If you divide the 2 million by the 600,000, and that's below his threshold, right? So more than likely, Frank might consider taking on the project. Now, you cannot use these things in isolation. Again, while this technique might suggest or approve or recommend that the project could be pursued, right? Depreciation is not taken into consideration at payback period. It ignores the time values of money. So using multiple methods as a manager might give you the best information or data available to make a more informed decision. Yeah. What about uneven cash flows? Now, with uneven cash flows, I mentioned that the cash flows, the annual cash flows are not the same every year. And this one is one that is a bit more, it's not difficult to calculate. It's another easy calculation, but it's a bit tricky when for one of the investments, as you'd see investment C, you are not evenly recouping the cash flow. You're not going to make back that money, that $20,000 in, let's say, exact 3 years, right? I'll show you what I'm talking about now. So CJ is considering an investment. She has 3 projects with yearly cash flows and the cost of the investment is $20,000, right? So the target or what we need to pay back is $20,000. Investment A, if we look at the accumulated cash flow, right? We're looking at a cumulative or cumulative cash flow where I am adding each year's cash flow until I get to the point that I have covered the $20,000. If we look at year 1, 2, 3, and 4 for investment A, right? Not until the 4th year, she's going to make or recoup $20,000, right? If we add 2,500 to 4,000 to 6,000 to 7,500, only in the 4th year is she going to recoup the $20,000? So it's taking 4 years to pay back the investment A, right? Investment B, right? All of them are the same $20,000, but they just have different annual cash flows, right? Investment B, they would recoup in 3 years, right? 5,000 plus 7,000, that's 12,000. Year 3, add another 8, you're at your $20,000 target, right? Investment C was that one I was talking about. Investment C, you have 8,000 in the first year. Second year, you have 6,000, so you're up to 14,000. Third year, right, 5,000. So in the third year, it takes us up to $19,000, but that's not 20. I still need another $1,000, right, in order to make my target of 20,000. Now, what do you do in an instance like this? And this would be the only difficult calculation for payback period. The extra $1,000 is a fraction of the cash flow for the following year, year 4, right? So it's 1,000 out of the 3. So the payback period is 3 years, right? Because we already recouped $19,000 plus a third of the following period, right? 1,000 out of 3. I'm using a third here because 1,000 over 3,000 is going to give me a third. So the payback period for investment C is 3.3 years, 3.3 years, right? So looking at all of the investments, the shortest payback period is going to be investment B, right? CJ is going to recoup her $20,000 in the shortest time frame if she goes with investment B. And if you're using the payback period as one of the appraisal techniques, then it's going to recommend or suggest investment B as a better option. Now, again, I said you cannot use these in isolation, right? Because they all have their advantages and disadvantages. So you may need to look at another investment appraisal technique to see, how they all line up and if investment B is still the better option out of the 3. All right. So the advantages and disadvantages of the payback period. Well, payback period, as you can see, is relatively easy to calculate. It just involves like adding, right? Only in the uneven, you're going to have to do a bit of division, but outside of that, it's really just addition and subtraction, right? Usually it's said to be more objective because it focuses on cash flows rather than profitability, right? And projects with a quick payback period minimizes time-related risk, right? Remember we were talking about that, right? For example, decrease in the value of money or changes in the external environment, right? The disadvantages of the payback period, though, is that it is mostly a measure of liquidity. It's only looking at cash flows. It does not take into consideration the overall worth of the project, right? Also, it does not take the expected life of the project into account. It does not just for the time value of money. We know this because we've been talking about it for some time now. And if we have more than one project, they could all end up with the same payback, although they have different annual cash flows. So how would you make a decision in that instance, right? So that's some of the shortcomings with the payback period. The other one that we're going to look at is the accounting rate of return. Again, another example of a non-discounted technique in the sense that it doesn't consider the time value of money. Now, what the accounting rate of return looks at or takes into consideration is whether or not a project is profitable, is really an indicator of profitability. And the formula for calculating accounting rate of return is it looks at the average annual return and divides it by the average investment, right? That's multiplied by 100 and it gives us a percentage. So ARR is a rate, it's calculated as a percentage. Now the average annual return is your total, what is that? Is your total annual income, right? Divided by the estimated useful life of the particular investment. The average investment is the cost of the asset plus its salvage value divided by 2. Just 1 second. Right. So I was saying the average investment is the cost of assets over the cost of the asset plus the salvage value divided by 2. Right. Now the rule for accounting rate of return is that one, we accept it when the expected rate of return, annual rate of return, exceed the required rate. Again, here, the company has to set some sort of benchmark, some sort of target in terms of what they want their required rate of return to be, right? They reject it if that ARR percentage is less than that required rate of return. So a company might say they're not investing in any projects that does not give an accounting rate of return of 20% or more or above 20%. So if they calculate the accounting rate of return and the accounting rate of return is 5% on investment, then they're not going to pursue that investment, right? If they calculate it and the accounting rate of return is 30%, their threshold is 20%, 20 or above, then they would accept or pursue that particular, or it gives greater credibility towards pursuing it. Again, you cannot base your decision to pursue a particular investment only on one particular appraisal technique, right? There are other things as well too that you have to take into consideration apart from your appraisal techniques. So I have a short video here on the accounting rate of return. I was going to look at explanation as well as an example, right? So we take a look at that now.
Don't forget, in A-level business exams, you're not given the formulae, so you need to remember the formula for calculating ARR. It's a percentage, and we do this by dividing the average annual return in monetary value, here in pound notes. We divide that by the project's investment and express that as a percentage. So we always multiply by 100 to get a percentage return. So let's take a look at an example of how we do this. You may want to pause the video if you want to have a go at calculating ARR on this project. A hotel looking to spend £2 million as an investment to expand the hotel, adding some new bedrooms and some new facilities. And we're given a table of information which shows the project cash flows, the net cash flows, over 4 years, in addition to the investment of £2 million going out. Don't forget, with ARR, if you're given a table with inflows and outflows, you'll need to calculate the net cash flows. But in this situation, a little bit easier, we're given the net cash flow numbers for each year. Okay, so let's have a look at how we calculate ARR for this business situation. There's the formula, and there are the numbers in the table there. 3 steps to calculating ARR. The first step is to work out the total return of the project. What we do for this is we add together the cash flows, the net cash flows, but most importantly, we need to remember to deduct the investment when we're working out this total return. So if we add together the 4 years worth of positive net cash flow, that comes to 3,250,000. That's the 500,000 in year 1, 750,000 in year 2, and £1 million of net cash flow in each of year 3 and 4. So that comes to 3,250,000. But don't forget, and this is often the stage that most students forget, we need to deduct the cost of the investment, £2 million, to give us a total return of £1,250,000. Okay, there it is, that's the total return. The next step is to work out the average annual return. And this is relatively straightforward. We simply take the total return of 1,250,000 and we divide that by the number of years of the project. We're given 4 years, so we have to use 4, divided by 4, which means that the average annual return, the top part of the formula, is £321,500 per year. Well, we're almost there with ARR. We need to do the final step in the calculation, which is to divide our average annual return by the investment. And again, it's straightforward. Here it is. There was our average annual return of £321,500. And we divide that by the investment. In this case, we're told it was £2 million. But don't forget, with ARR, we need to show that as a percentage. So we do that division, 321,500 divided by 2 million times by 100 to express it as a percentage. And the ARR for this project is 15.63%. Don't forget, with ARR, the key thing there is to remember to deduct the cost of investment from the net cash flows when we're calculating the total
right? Very important when you're calculating the accounting rate of return, it's always important to deduct in year zero the cost of the investment as the source of most students' mistakes when they calculate an accounting rate of return. They look at the net cash flows from year one to whichever is the final year, and they forget to deduct the total cost of the investment.
Don't forget in
So the advantages of the AR, as you can see, is very simple to use and understand. It's a straightforward calculation, you know, just like how you calculate simple interest or any of those other simple type math formulas. It takes into account the total earnings of the project. So just like that example we look at with the hotel as billing the additional rooms and the spa, they're going to be looking at the total earnings coming in from that project, right? It considers the whole life of the project, right? And it's easy to compare returns on different options. Maybe they may have an option of the 10 rooms and a spa in comparison with probably including an additional pool. And they could compare the rate of return on each of those projects and then make a decision in terms of which one is going to have a higher rate of return. Again, the disadvantage, just like the payback period, because these are non-discounted cash flow techniques, it ignores the time value of money. There's no consideration in the calculation for you know, what in the fourth year when you're receiving $500,000, then what would be the value of the money then? You know, the purchasing power rather of that money then. It also ignores the timing of the cash flows, right? It ignores the accrual concept of accounting, and it's a bit more difficult than the payback period to calculate. All right, so that's the advantages and disadvantages of the ERR. Important for you to know. Sometimes they always ask that as a part of the question. Now we get into the discounted cash flow type investment appraisal techniques. And the first one we want to look at is net present value, because the IRR is based on the net present value as well. Now, the net present value, when you hear the term net present value, is the difference between the present value of cash inflows and the present value of cash outflows, right? That occurred as a result of the company taking on that particular investment, all right? So, not to be confused with net book value, this is net present value. So it's looking at the difference between the present value of the inflows and the present value of the cash outflows. So remember, the inflows could be money that is being earned 3-4 years down the line. So we have to adjust those cash inflows so that we would have an understanding of what that money is worth today, right? Now, when we calculating the net present value for a project, the answer we could get could be positive, it could be zero, or it could be negative. And we need to understand what positive, zero, or negative NPVs mean, right? Abbreviation for net present value is NPV. A positive NPV means that the present value of the cash flows, right, is greater than the present value of the cash outflows, right? So you say that the NPV is positive. And if this occurs, the investment proposal could be accepted, right? Given a positive NPV. The other type of NPV is a zero NPV, right? And this is where the present value of the cash inflows is equal to the present value of the cash outflows, right? So the net present value is zero. And we could also consider the proposal as being acceptable there, right? It just depends on management and what they want to do. But what happens when you have a negative NPV? When you have a negative NPV, it means that the present value of cash inflows is less than the present value of the cash outflows. And that gives rise to the negative NPV. And when that happens, at this point is where we will reject the investment proposal. All right, so a negative NPV means that we are not going forward with that investment. Right, so this is a summary of the possibilities, right? We should learn these. Let's look at an example. Let's understand with the example. The management of fine electronics companies considering purchasing equipment to be attached with the main manufacturing machine, right? So additional equipment. The equipment will cost $6,000 and will increase annual cash flows by $2,200 each year, right? Annual cash flows. The useful life of the equipment is going to be 6 years. After 6 years, it will have no salvage value. And management wants a 20% return on all investments. right? Required compute a net present value of this investment project and say whether the equipment should be purchased according to the NPV analysis. So computing the net present value, the initial cost is $6,000. The life of the project is 6 years, right? The good thing about it is we have, similar to the payback period, this is an even cash flow for net present value. Every year you are going to get 2,200 flat from years 1 straight to year 6. There's no salvage value, right? And the required rate of return is 20%. Now, how are we using this information to work it out? Now, there's something called a present value annuity table of $1. And what it does is based on that percentage return that they're talking about, we are looking at 20%. That's what the company wants. You have a discounting factor that you could use for $1, right? This is for every dollar that is gained or spent. For each year, this is the percentage here, right? Discounting factor percentage or the required return, rate of return. And these here are the years, year 1, year 2, year 3, 4, 5, 6, 7, going all the way down. All right, this is important. You must have this table when you're working out NPVs. Now, in the working, right, the annual cash flow from years 1 to 6 is $2,200. It's the same every year. The 20% factor, discounting factor, right, is going to be 3.326, right? Where are we getting this from? Well, if I go to 20% here, right, that's my 20%. And I look at year 6, you see that my discounting factor is 3.326, right? So that's the present value of $1, right? At 20% rate of return 6 years from now. That's how you use the table. Now, when I multiply my cash flow by my 3.326, it's going to give me the present value of the cash flow, right? That's my inflow, right? The outflow now is the initial investment, and that's happening now in year 0, is $6,000, right? It's negative because it's going out. In year 0, your discounting factor is always 1, right? Because the value of the dollar now is the value of the dollar now. We don't need to discount that dollar, right? So we multiply that initial investment by 1, right? Now initial investment is our outflow, so is represented by a negative figure. And it gives us a positive net present value. Now we said that if we have a positive net present value, right, we could accept the investment, or even if you have a net present value of 0, we could still accept the investment. So given that we have a positive value, which is 1,317, we could, right, take on the investment. However, the positive NPV shows that the project, it would promise a rate of return that is higher than the minimum rate of return required by management, which was 20%, right? Now the required rate of 20%, right? That was the minimum rate of return required by management. What does that mean? It means basically that if the equipment was not purchased and the money was invested elsewhere, the company would be able to earn 20% return on that investment. And this is why they're saying that the minimum required rate of return is 20%. And we use this to discount the cash flow, right? Its present value. And we refer to it as a discount rate. You heard me using it before, right? It was the required rate of return, yes, but we are using that to go to our annuity table to calculate what the discount rate is. What it does is in the 6 years going to discount that rate, that funds that we will earn. If we get a positive NPV, then it says that yes, we would more than likely surpass that required rate that the company is asking for. Now, when we invest in assets, right, we usually make that investment in assets. The intention is to generate revenue later on, right? Just like what they did with that additional equipment, or it could be to reduce cost as well. right? The reduction in costs is usually considered to be equivalent to an increase in revenue, right? Because if you reduce costs, then you have a bigger margin of profit. And because of that, it is treated as a cash inflow when we're looking at capital budgeting computations. So the net present value method is not only used to evaluate investment projects that generate cash inflows, like the example we looked at as well a short while ago, but it also could be used to evaluate projects that help to reduce costs. And I have another example here that could show us that. So this project requires an initial investment of $225,000, and it is expected to generate the following net cash flows, right? This is a good example here too of uneven cash flows. So unlike my previous example where we had a consistent 2,200 inflow every period, here every year I have different amount of inflows coming in. And you would notice that my table change. I am no longer listing from years 1 to 6 and using one discount rate. No, I have 4 years and I have the present value of $1 at 12% because the desired rate of return is 12%. That was given by the company, right? So if I look at the table, right, this is the table here. This is 12%. For each of the years, I'm going to be going now up to year 4. So year 1 is going to be, this is the discount rate for year 1. This is the discount rate for year 2. This is the discount rate for year 3. And this is the discount rate for year 4. I would be multiplying the cash flows in each of those years, right, by the present value of $1 at 12%. So year 1, as I mentioned, was 0.893. If we saw that a short while ago. Year 2, 0.797. Year 3, 0.712. Year 4, 0.636. You see, as the years go by, the present value at 12% is decreasing. I would then be multiplying those discount rates by the cash flow for each of those years to give me the present value of the cash flow, right? So in year 4, I'll be receiving $55,000, but the present value of that cash flow would be $34,980 because, like we said, in time value of money, the $55,000 wouldn't be worth the same in 4 years' time, right? And using that present value table, if you're going at a rate of 12%, in year 4, that 55,000 discounted present value figure will be 34,980. The purpose of me doing this is for me to calculate the total net cash flow, right? If I discount all of them and I add all of them up, I'm going to get 226,295. If I subtract the total cost of my investment, which is 225,000, from this total cash flow, I am going to get sorry about that. I'm going to get a positive net present value, right? And we said that if we have a positive net present value, that's an indication that we can accept the investment or the project. All right, so our net present value here is positive. I have a positive $1,295. All right. So now we'll just look at another short video explainer on net present value. Sometimes it's a bit difficult for students to grasp. So let's look at a explainer an example here with this video. Yes.
We're going to talk about a really important concept called net present value, which is really one of the key concepts that you take away from studying introductory finance. So when we talk about net present value, well, what do we mean here? What are we talking about from a conceptual point of view? Well, we're talking about taking a project or something and saying how can we value it in terms of the cash outflows and the cash inflows. So let's use an example here. So we've got some project at our firm that we're trying to make a decision. Do we accept this project or reject it? Okay, we only have so much money at the firm, so we have to be judicious about how we spend it. We need to know, okay, is this something that we think we should do or not? And so how do we go about making that decision? Well, we can look at the cash flows associated with this project. So let's look at, in terms of time periods, let's say this is time period 0, and we got time period 1, that's the end of year 1, end of year 2, end of year 3, 4, and 5. So let's say this project ends at year 5. It's a 5-year project. We're debating whether we want to take it or not. Now, what we want to do is we want to map out these cash flows. So let's say that the project is going to cost us initially in period 0. So this is upfront. Period 0 is right now. Let's say it's going to cost us $10,000 that we're going to have to invest to get this project going. We have to buy a machine or something, or whatever. Let's not really get into the details, but $10,000 we have to lay out in order to start this project. So that goes right here. So that's negative. That's a cash outflow. This is a negative number. Okay, so $10,000, it's an outflow. But now we want to think about the inflows of this. So let's go ahead and we'll say that we'll have in year 1, let's say that we'll have inflows of $2,500. Okay, now that's positive. This is going to get added ultimately. And then we have in year 2, this project, if we accept it, will generate $4,000 cash, and then $5,000 in period 3, $3,000 in period 4, and then the final period it'll generate $1,000 of cash. So what we want to look at is we want to look at the cash flows, and we want to say, okay, let's find a way that we can somehow account for the time value of money, because we know that $1,000 in period 5 is not worth $1,000 today, and we want to somehow net these cash inflows with the cash outflow. So how do we go about doing that? Well, we are going to have to calculate the present value of each cash inflow. We can't just use an annuity formula because the cash inflows are a different number in each period. So what we'll do is we'll treat each one as a single cash flow, and then go ahead and discount it back to what its value is at period 0. And we don't have to discount the negative 10,000 because we know that negative 10,000 that's negative 10,000 today, so we don't have to worry about that one. But we're going to have to discount the other cash flows here. So what we're going to ultimately have is an equation that is going to look like this. So our net present value is going to be equal to negative 10,000. Again, we do not need to discount that because 10,000 today is 10,000 today, so we don't have to worry about that. But then we're going to add to that the cash inflows, but discount it. So we've got the 2,500 that we get at the end of period 1, but we have to discount that. So let me just go ahead and rewrite the formula for present value of a single cash flow. That's C being the cash flow over 1 plus R to the T, and in period 1, of course, T is 1, so we don't even concern ourselves with that. And then also, just a side note, we're going to need a discount rate here, and we'll say that the discount rate we could have earned. Let's say that we could have earned 6% on an investment with a similar risk. That's our opportunity cost. We're going to need that to calculate this formula here. So we're going to use this formula, and now we're going to calculate the present value of that $2,500 at the end of year 1. So we've got the 2,500 in the numerator, and then in the denominator we're going to have 1 plus R, and we know the R being 6%, 1 plus R is going to be 1.06. Okay, now
You good?
the year 2's cash flow.
Now, you wouldn't need to do this calculation, but still are good to know, right? But present value table is going to give you these figures here, right? It's going to give you those figures, but you could also calculate it like this as well, all right?
Of $4,000, we're going to have to treat that as a separate cash flow. Okay, now that's going to be discounted back 2 periods because that's 2 years from now. So it's to the second power, that t, the time period. Now for the third period, we've got 5,000 in terms of the cash flow, but we're going to have to discount that back 3 periods. And then we've got, at the end of year 4, we get $3,000, and we'll discount that back 4 periods. And then finally, at the end of the project, we get a cash inflow of $1,000, which will discount back 5 years. So ultimately,
Let me just stop him there one more time again, right? Now, each of these calculations here is going to be equivalent, right? It's going to be equivalent to that figure that I would have received after I took whatever the discount factor was. Remember, just now we had like a 12% discount factor, and let's just say it was 0.837. And in that year one, let's say my cash inflows was 4,000. And when I multiply those two together, right, it gave me my discounted cash flow of 3,348. Let's just say, just using a rough example here. This figure here is going to be the result of what he's doing here, right? So it is not, don't confuse this calculation to be the discount factor that we're using from the table, right? Rather, this answer that they will be getting there is the answer that we got after we multiplied our discounting factor from our annuity table by the cash flow. So these two things here are going to be the same. You all understand that? Right, so this is a useful formula for you to know. In the exam though, you guys will get an annuity table to use, so you're not going to have to actually calculate it. Later on though, you would probably need to know this formula if you continue with your business, if you continue with your account studies. Everybody clear on that? Yes?
Yeah, yes, sir, yes, sir.
Yeah, right?
Yes, sir.
Okay.
this formula here is going to yield our net present value. Okay. Now, and then we'll talk about how to interpret that and what we're going to do with it in a moment, but let's just go ahead and finish out these calculations. So this net present value is going to be equal to that negative 10,000 that we incur up front to start this project, and then all these cash flows here, when we add that all up, it's going to add up to $13,239. So now this is where the net part comes in. We net these together. We're netting the cash outflow. This is going out at the beginning of the project, and then we've got the inflows. This is the discounted value of the inflows. We take it together, and that's going to give us $3,239 is the net present value of this project. Well, what does that mean and how to interpret it? Well, in general, assuming that the company has enough cash to do the project, what you want to do is you want to use a kind of rough rule here of if the NPV is greater than 0, then accept the project. Accept. So, and then of course 3,239 is greater than 0, so we would accept by this rule. Now let's explain this rule here in a little more detail. What is this saying if the net present value is greater than 0? Well, remember our discount rate that we chose of 6%? Well, ultimately, we can kind of view that as an opportunity cost, this 6%. If we don't invest the money in this project here, if we don't spend it there, well, it could be somewhere else. Maybe you could have invested it in stocks or bonds or something that would have earned us this 6% return. So the capital is not free. The money to do this project is not free. It could have been deployed elsewhere to earn a return. And so when the NPV is greater than 0, what this is basically saying is that we have added value to the firm above and beyond the 6% that we otherwise could have done with that money. So
Now, that's the most important takeaway from this video I want you to understand, right? The positive value of the NPV really kind of gives some sort of inclination as the opportunity cost. If they had invested this money elsewhere, right, they could have earned 6%. For every dollar above or every time that we have an amount over the zero for the NPV, right, that's additional value that you have added to the company above and beyond the 6% that you would have gained if you had invested it elsewhere. All right, does that make sense to you? I'm gonna go back. Oops, not that wasn't back that I wanted to go.
we're going to talk about a real and so when the NPV is greater than 0, what this is basically saying is that we have added value to the firm above and beyond the 6% that we otherwise could have done with that money. So by accepting this project, we're actually earning a return to the firm that is higher than this discount rate that we were thinking about, higher than the opportunity cost. So we could have made 6% elsewhere. Did we do better than that? That's what we're trying to figure. And if the NPV is greater than 0, then the answer is yes, we did do better than that. And so we need to accept the project.
Right. So that gives rise to my other question. We did say before that at 0, we could accept it, right? We can't accept it because it means that we are still earning. But NPV of greater than 0 is better than an NPV of 0. All right, everybody understand that? Right, so now the other one, which is the internal rate of return. Now the internal rate of return is somewhat based on the NPV, right? And for that reason, I chose to look at the NPV before we look at the internal rate of return and do this one last, right? Now the internal rate of return, also known as the yield on a project, this is really the rate at which the investment is going to promise to generate a return during its useful life. It is still going to use that discount rate, right, that we saw in the NPV, right? And basically, what we are trying to find is the discount rate at which the present value of the project cash inflows, the net cash flows is equal to the present value of the net cash inflows. So in other words, you're trying to find the rate, the discount rate at which the project NPV is going to be equal to 0. You want to know what is the discount rate at which the NPV is going to be equal to 0. That's basically what the internal rate of return is calculated. That's the most important takeaway in terms of defining the internal rate of return, right? You're really trying to find a discount rate at which the project net present value becomes 0. And the formula for doing that is taking the net initial investment and dividing it by the annual cash flows, right? Obviously, you multiply by 100 because it's a rate and therefore it's a percentage. So here's an example of that internal rate of return.
In this video, I'm going to be talking about IRR, otherwise known as the internal rate of return. Now, the internal rate of return is a way of evaluating a project and coming up with a decision to accept or reject that project. Okay, so this is very similar in a way to NPV. Now, when we think about NPV, we think if the NPV is greater than 0, then accept. That's the decision. That's our decision rule. So IRR is kind of related in that sense, and that ultimately it's going to lead to a decision rule. But first, in order to understand what IRR is, let's kind of work a problem here with NPV and then show how we do it with IRR. So let's say that we've got some project. So we've got an example here. We have a project, and this project is going to have, it's just going to be a 1-year timeline. And at the beginning of year, or at year 0 right now, we're going to have a cash outflow. We're going to invest $100. So that's a negative 100. And then at the end of year 1, we're going to receive a cash flow of $130. So this is a very simple project here. paying out $100 and then getting $130 back at the end. Now, in order to calculate this with our NPV, the other way, holding off IRR for a second and thinking about NPV, we're going to need to know the discount rate. Okay, little r, we'll call that. And so let's just say that the discount rate, let's say it's 8%. Right. Now, I'm just briefly going to go through how we would do this under NPV. And refer to the NPV video if you haven't seen this yet. The NPV is going to be -100, that cash outflow, plus 130, but we're going to take that over 1 plus R, 1 plus that discount rate. And we need to do that because of the time value of money. So ultimately, that NPV, this is going to be 130 over 1.08. With this 0.08, we're just that's just that 8% discount rate. We're converting it to a decimal and adding 1 to it. And ultimately, this is going to give us a net present value to this project of $20.37. So now if we think about our decision rule, well, is this greater than 0? Well, yes, it is. So then according to the NPV, you would accept this project and go ahead with it. But let's think about IRR now. Well, how is IRR different from NPV? Well, ultimately, what we're going to do with IRR, let me just say IRR here now so I make this clear. I don't want you getting confused. So with IRR, we are going to set the NPV equal to 0. We're going to set the NPV equal to 0. So then we're going to still have that -100, the cash outflow, that thing from here, that's still coming down. And then we're going to have 130 over, and this time I'm going to have 1 plus, but I'm going to put big R instead of little r. We're still going to have little r over here being our 8% discount rate. You say, okay, well, what is this big R then? What is the difference between big R and little r? Well, what we're going to do is we're going to try and solve this and figure what is the big R that we would have to plug in that would make this equation so that the NPV is equal to 0. So, and then once we've determined what R is, we're going to take R and compare it to that 8%, and that's going to be our decision rule. So let's go ahead and let's just solve this for a second. So ultimately, we're setting the NPV equal to 0, and then we're solving for the R that would make this equation true. So ultimately, you can do some algebra here, but you'll end up with an R that is equal to 0.3. 0.30. I'm going to say because we're going to convert that to a percent, so we can easily compare these two. So we've got the big R is 30%, and then the little r is 8%. So what does that tell us? Well, we know that 30% is greater than 8%. Okay. Well, what does that tell us? Well, if the big R, our decision rule, if big R is greater, if big R is greater than little r, then accept. Okay. That's our decision rule. Now let's think about what this means here conceptually. What we're trying to do is we're saying, okay, the NPV, we're ultimately going to say that's kind of our break-even point, so to speak. Because when the NPV is 0, what does that mean? That means that wealth is neither being added nor destroyed at the firm, because you're just earning this opportunity cost or cost of capital, however you want to think about it. You're just getting that 8%. So that's this NPV, when it's 0, that's our break-even point. And we're saying, what return would we have to have? What big R would there need to be in order to get the NPV to equal 0, to get to that break-even point? And we see that, okay, well, we have a return there of 30% would make the NPV equal to 0. And then we say, okay, well, let's compare that 30% to what our opportunity cost of the capital is, or our discount rate, however we want to think about it, and let's see if it's larger. And then we look and we say, okay, clearly the answer yes. So ultimately, we can think of IRR is the discount rate that makes the NPV equal to 0. That makes NPV equal to 0 to get us to that break-even point. We just ultimately say, instead of calculating the NPV directly, which we did under the NPV decision rule, we're just going to set NPV equal to 0 and then solve for the R, the big R. In this video, I'm going to be talking about IRR, otherwise known as the internal equal to 0, to get us to that break-even point. We just ultimately say, instead of calculating the NPV directly, which we did under the NPV decision rule, we're just going to set NPV equal to 0 and then solve for the R, the big R, that would make this equation true, where we find that big R that makes the NPV equal to 0, compare it to our discount rate, and if it's greater, then we accept the project.
Right, so that's internal rate of return. This by far is probably one of the more complicated ones to calculate, and sometimes to understand as well, right? Because it's kind of leaning on that net present value, right? Now, the thing with the IRR is while it considers the time value of money, right, using it alone to make a decision might not be advisable, right? As a very high projection for the IRR sometimes is not realistic. As you could see in this example, what he did, it was 30% versus the 8%, right? Any questions on what we looked at so far on our investment appraisal? This is the end of our handout. Any questions?
Yes, I have. Yeah.
Okay, Justin, how about you?